Hello and welcome to Morning Brief Market Sunrise. I'm Ramzan Karmali, live from Yahoo Finance's studios in London. It's Monday, 3rd November. Coming up on the show, President Trump says that China can't have Nvidia's top AI chips. The government shutdown rumbles on, and this week could become the longest one ever. And earnings remain in focus with the likes of Palantir, AMD and Qualcomm all on deck this week. So grab your coffee and let's own the morning. All right, let's kick off the things you need to know before the opening bell rings by taking a quick look at where the US stock futures stand. And it's looking like a slightly positive picture at the moment as Wall Street looks to extend last month's momentum into November. Okay, the first thing you need to know is that President Trump has said that China can't have Nvidia's top AI chips. He wants Nvidia's Blackwell chips to be sold to only US customers and no other countries. This suggests that Trump may impose tighter restrictions around cutting-edge American AI chips than US officials previously had indicated. Now remember, on Friday, Nvidia said it would supply more than 260,000 Blackwell AI chips to South Korea, including to Samsung. Okay, the next thing you need to know is that the Trump administration cannot suspend food aid to 42 million low-income Americans during the government shutdown. 2 federal judges ruled that SNAP benefits must continue to be paid. The government shutdown is poised to become the longest ever this week, as the impasse between Democrats and Republicans dragged into a new month. And the last thing you need to know is that OPEC Plus agreed to a small oil output increase for December. The oil cartel also announced yesterday that it was to pause increases in the first quarter of 2026. OPEC Plus said the decision reflects an expectation for a seasonal slowdown. Now, the move comes against a backdrop of widespread forecasts for excess supplies next year. Over the past 12 months, both main benchmarks have fallen around 15%. Well, last week we heard from oil giants Exxon and Chevron, and tomorrow BP will report its latest earnings before the opening bell. Chevron CFO Emma Boner gave my colleague Julie Hyman her take on the current forces impacting the demand and supply of oil.
We're planning for expecting more of a supply-driven pressure on price. Demand has been incredibly resilient. It is growing, and so we expect that it'll continue to grow. But supply, given that we've got some non-OPEC production that's growing, there's also some unwinds happening, and they'll continue to happen, is our prediction. So we're preparing for some softness. And again, because we make all our investments with the long term in mind, with through cycles in mind, we're prepared for any price environment should we see some pressure in the next couple of years. So we expect there may be some pressure. We've seen prices relatively flat quarter on quarter, but certainly drift into Brent into the high 50s just in the last month. And so we're prepared for that with the investments that we have. We're prepared for that with the capital that we have planned to spend. We came into the year with capital lower than the year before, both on the organic side and the affiliate side. And then we've also got a significant cost reduction program underway that's making good progress and delivering the synergies from the Hess acquisition. So all of those things, coupled with the AA balance sheet, make us feel confident that we're prepared and we can navigate it, even if we were to encounter lower prices over the next couple of years.
Emer, speaking of sort of navigating the unpredictable, I have to ask you about a sort of developing news situation in Venezuela. Chevron has a license to drill there, of course, that was renewed earlier this year after an interruption. At the same time, we've seen U.S. tensions in Venezuela increase. Airstrikes on boats in Venezuelan waters. President Trump hasn't ruled out targeting land targets as well. So are you confident you'll retain the license there? And what do the tensions there mean for your business and the employees who are based there?
Well, first of all, what I would say is we've got 100 years of history in Venezuela, and our view is our presence has been very constructive for the people of Venezuela and the US. We have a limited amount of oil coming from Venezuela to the US. Think of that as about 8 to 10 cargoes a month. And, you know, the cash contribution from those cargoes is really paying debt that we're owed over time. And so that's how to think about the operations and the financials. What I'd say about what's going on in Venezuela, I mean, we are always and are compliant with US sanction policy and the laws and regulations. So everything that we're doing is compliant with that. And it goes without saying that the safety of our people working there is our top priority. So, you know, we feel today that, you know, our people are safe, and we are always focused on ensuring that's the case.
Eimear Bonner, Chevron CFO, thank you so much. Really appreciate your time.
Well, for market movers, we're going to focus on AI, and we start with some breaking news. Data center owner and operator Iron has signed a nearly $9.7 billion cloud services contract with Microsoft to provide the tech giant with access to Nvidia's GB300 processors over a 5-year period. The move is the latest attempt by Microsoft to boost AI and data center infrastructure at a time when AI demand is outstripping cloud capacity at big tech companies. It's also another busy week of earnings, and the AI trade will remain front and center for investors, with Palantir, AMD, Supermicro and Constellation Energy all set to report quarterly earnings. Palantir will report after today's closing bell. Its shares are up 165% this year so far, and some analysts believe there's even more to come. Wedbush Securities just raised its price target to $230 from $200. It sees strong momentum in the firm's AI business and thinks Palantir could become a $1 trillion company within the next 2 to 3 years. Another firm reporting this week is AMD. In fact, tomorrow after the closing bell. It has a history of exceeding Wall Street expectations, beating revenue estimates every single time over the past 2 years. But just last week, Qualcomm, which also reports this week, announced it will release AI chips to compete with AMD and also Nvidia. This move by Qualcomm to enter the data center marks new competition in the fastest growing market in technology, equipment for new AI-focused server farms. Another stock to watch in this space is Micron. With a wave of interest in AI and memory chips driving the sector, momentum is really building for Micron. Just look at its share performance. Its price has more than doubled in the past 3 months alone. But perhaps a slight word of warning. It's now trading above most analysts' price targets. So the question investors need to ask is whether there is still value to be unlocked. But the daddy of AI, Nvidia, which recently became the first $5 trillion company, remains the dominant name in the sector. Its leadership in advanced GPUs has given it a huge lead in AI processing, and it's pretty fair to say its big wins in AI have translated to some incredible gains for shareholders over the last 5 years. Okay, we are time for a short break now, but stick with us as Brian Mulberry from Zacks Investment Management will help us look ahead at some of this week's key market events. Stay tuned. Welcome back. Time now to dive deeper into some of the most notable stories expected to develop this week, including Tesla signing off Elon Musk's potential $1 trillion pay packet and the ongoing market reaction to big tech spending on AI. Well, I'm delighted to be joined by Brian Mulberry from Zacks Investment Management. Brian, thanks so much for joining us here on Market Sunrise. Well, let's start with your reaction to the results that we heard last week from big tech. Who are the winners and who are the losers amongst the 5 that we heard from?
Well, certainly the whole group itself. We have 6 of the 7 Mag 7 names having reported already in the last couple of weeks. Revenues up over 17.5% year over year for this quarter compared to Q2 at 15.5%. So they're just accelerating more and more in this bucket of big tech. Obviously, the only name that really didn't perform really well was Meta. And it's simply because they don't have an alternate source of financing for the CapEx that they're proposing. It's all still just ad revenue. When you look at Microsoft, Amazon, and Google, they're growing their cloud business by the mid 20s to mid 30%, and that's financing the capex. So the market investors are rewarding them because it's not really going to be overly dependent on one source of financing and not going into debt on their balance sheet. And so that's really the whole thing. Capex going forward means more revenue in the next several years. We're starting to see cloud revenue peak and level off a little bit simply because they're bumping into capacity issues on the compute side. So these data centers that names like Microsoft, Apple, Amazon, Google have all proposed, they need to start landing. They need to start producing more compute power so that they can get back on track in that revenue growth over the next couple of years.
And they're certainly talking a good game, aren't they, Brian? They're talking up, the investments that they're making. But are you worried that perhaps, there has been talk in recent weeks of an AI bubble. Are you worried that perhaps there is a bit too much focus on this and maybe their core businesses are being ignored?
Well, I think, in terms of a bubble, I'm not sure it's an asset bubble, meaning the stock prices are being backed up by this strong revenue growth. It might be a spending bubble. It could be a CapEx bubble, in that the concern is the adoption rate of AI commercially and from consumers has to keep pace with this amount of spending. If the adoption rate continues to be strong, meaning there's demand for all of this compute that they're trying to build out, then it should work out to be profitable over the long term. The worry would be that there's some type of an event that slows down AI adoption, and now you've spent all of this money on unused capacity. That's where you start to lose money, and it feels a little bit bubblish on the spending side, not necessarily on the stock price.
Now, another stock that's going to be in focus this week will be Tesla. Shareholders have until midnight on the 5th of November to basically approve Elon Musk's pay packet. And now we know that the Tesla chair has come out and she said that, we want shareholders to approve this. What do you think will happen? And is he worth $1 trillion?
Yeah, it's, given the metrics that they've put into this package, and it's important, I think, to note right up front that there's no base salary, there's no cash, there's no bonuses. It's all performance-based awards, and that keeps Elon engaged in the business, I think, in a very productive way. You're talking about some metrics about having 100 million units on the road over the next 10 years, growing the robotaxi fleet to 20 million, 1 million Optimus robots. You have to have another 10 million new users in the power generation side. This is substantial growth for a 10-year period of time, where the market cap should go from somewhere around $1 trillion to $8.5 trillion by itself. Why shouldn't the CEO participate in some of that? That seems to make sense. Now, there are a lot of questions about should anyone have $1 trillion worth of wealth. That's not really for me to say. As a shareholder of the company, this type of metric of growth, there's clawbacks that are built in. If he doesn't meet these milestones, he won't get paid that excessive pay package. But as a shareholder, if all of these things fall into line in the next 10 years, we'll all make a lot of money. And so I would say it's probably worth it.
Now, Tesla's share price, though, in comparison to the other big tech firms, has not really performed, to be perfectly honest. So is there maybe a bit of this is a bit like saying to someone, look, you haven't really performed, but if you do, we'll reward you really well. Is this sort of a stain on Elon Musk that they don't really rate his performance this year?
Well, I think there's no question about it. Tesla's had some issues in terms of growing as fast as the other big technology companies. There's been some production issues, but obviously some demand issues at the same time. Here domestically in the US, you had a very large subsidy that was provided to EV buyers across the board. Tesla, being the biggest EV manufacturer, takes the biggest hit on that. So there's certainly issues out there for Tesla. Again, this particular package incentivizes growth on a very large scale over a 10-year period of time. So it would be simply returning back to that growth rate where they were maybe 5-6 years ago and looking forward 10 years, restoring that track.
Brian Mulberry from Zacks Investment Management. I'm afraid that's all we have time for. Many thanks for joining us here on Market Sunrise.
Thank you.
Okay, it's time now for another quick break, but stay tuned for today's trending stocks, including one you've probably never heard of, exploding around 75% at market close on Friday. It's time now for today's trending tickers, from AI bonds at Google to EV supply chain shifts for Tesla and viral smartphones. First up, Alphabet. The Google parent is issuing roughly $3.5 billion in euro-denominated bonds to raise capital for its AI and cloud infrastructure expansion. That's according to Bloomberg. That's the second time this year Alphabet tapped the euro bond market, showing how the AI arms race continues to be fueled by huge debt. Google is in a strong position to pitch to lenders after strong earnings last week. And just to put this into context, the Alphabet shares are up a staggering 75% in just 6 months. Next up, Berkshire Hathaway. Warren Buffett's firm just reported Q3 earnings of about $30.8 billion, up from $26.3 billion a year ago. But the standout sign that everyone's watching, Berkshire offloaded more than $6 billion worth of stocks this quarter amid sky-high AI valuations. And they've got a record cash pile of, brace for it, roughly $381.7 billion. Meanwhile, Tesla remains at the center of attention this week. We're just 3 days away now from a shareholder vote on CEO Elon Musk's $1 trillion pay package. And remember, the stock closed 3.74% up on Friday. But we just got news that sales of Tesla continue to fall in Europe. The automaker's new car registrations dropped a staggering 89% in Sweden in October. Today, Tesla news is also helping boost another big name, South Korea's Samsung, whose stock has been absolutely soaring in recent months thanks to its artificial intelligence progress. After announcing a major deal with Nvidia last week, today's news, as reported by the South Korean press, is that Samsung will be supplying over $2 billion worth of energy storage system batteries to Tesla over the next 3 years. And look at how the South Korean tech giant has been rising here. If confirmed, this may indicate new plans for Tesla in the field of grid-scale electricity storage. One more story to watch in the EV universe today. BYD, Tesla's Chinese rival, is seeing signs of pressure, with its profits continuing to decline in Q3, down about 32.6% year on year amid an ongoing price war for EVs, especially in China. And finally, one unusual lighter story that's moving markets. Xiaomi, which has been facing big problems with its electric SUVs in recent weeks, is up more than 3.5% in Hong Kong today. And that's mostly thanks to its smartphones. What's interesting about it is that in part the stock is being propped up by China's leader Xi Jinping. Well, Xi actually gifted a pair of Xiaomi smartphones to South Korea's president at the APEC summit, and he joked about, quote, security backdoors in Chinese devices. That buzz is definitely helping the brand today. And as promised, here's a mysterious stock that has been soaring. AMTD was up nearly 75% on Friday. We'll keep watching the company, which is active in fintech and other sectors. Okay, time to talk about a key question that's on everyone's mind now. Will the Fed cut rates in December? Jay Powell hinted that there might be a pause in rate cuts, but of course investors are weighing scenarios and placing their bets accordingly. Simon Heyman, who spoke to my colleague Josh Lipton on Friday, has an interesting theory. Take a listen.
There's two announcements that came out this week. Number one was the firming of the commitment of purchases from China of U.S. soybeans, largely 25 million metric tons. That's great. That's back to about normal levels of purchases. I think China had held off to create leverage in the trade discussions, but it seems like they're back in the ballgame. Now we need to see that firm up and have those purchases actually happen. But there's a commitment of about 12 million metric tons yet this year. That's a great rate for the rest of the year, and then 25 for the next years after that. That's the number one thing that's going to give farmers.
We like the logic that I call 2-3-4. What is 2-3-4? If we get to inflation of 2%, then Fed funds should be 3, and the 10-year Treasury should be 4. So we can call this the last of the easy Fed cuts because inflation's not at 2, it's at 3. So therefore, Fed funds in a neutral spot would be 4 right now. Hence, this is the last of the easy cuts. And I think that's a lot of what Chair Powell said. The next one's not going to be easy. We're going to have to start to make some progress to 2% to cut meaningfully further, and that's important. But the other takeaway of 2-3-4 is what's already at 4. The 10-year is already at 4. No surprise that it sold off just a little bit. You had 25 bips off Fed funds, and the 10-year yield went up 10 basis points this week because we're we're not all the way down to 2% inflation.
Well, let me ask you, if you were spinning ahead in December, and let's say you did get a pause, I'm curious how you think the stock market would react to that.
So I don't think that that's much of a headwind for the equity markets, nor would I suggest that a cut is much of a tailwind, because the long end is likely to be stable. Multiples for at least large cap stocks are more driven by the longer end of the curve, which is probably going to be range bound for the logic of 2, 3, 4. Now, you can still get a little bit of a benefit to small cap stocks in emerging markets, which have more debts at shorter term maturities. So there you can see a little bit sensitivity to whether the Fed cuts or doesn't cut.
What about those, there were folks on this very show, Samin, who weren't so sure they should be cutting. Their point being GDP is hanging in there, unemployment's low, the stock market's working, not typically an environment you'd be cutting into.
No, that's exactly right.
Yeah.
In other words, we are probably around neutral right now if inflation is at 3%. And if the risks of the employment market and inflation are roughly balanced, you should stay here until inflation gets down. Now, one of the important things, if you were listening to Powell's comments, was he's actually in the camp that we're closer to 2 than people think. He suggested that their approximation, in the absence of all the data we have, is actually more like 2.8%. And they're still very convinced, we heard this years ago from the post-COVID context, but very much in the context that any tariff impact would be transitory.
Okay, that was Simeon Hyman from ProShares talking to my colleague Josh Lipton there with his interesting take on the Fed. Okay, before we go, let's check in on the markets and let's start with crypto. And Bitcoin, like all other cryptos, is actually falling this morning. Investors are perhaps more cautious this week ahead of data and lukewarm institutional demand. Also, several crypto online forums are suggesting that older holders are actually selling right now. Okay, let's move on to gold. And the price earlier fell below $4,000 an ounce, but it's back above and rising again. So perhaps a move towards the safe haven in this pretty interesting week might be on the cards. Okay, let's move on to Asian markets now. And there's no Nikkei, you may have noticed there. In fact, we've got the Chinese local market there, the Shanghai Kospi there. Shanghai, the Hang Seng and the Kospi on the board there. Japan is closed for a public holiday. Asian markets in the main were up, following on from Wall Street's pretty impressive performance again on Friday. Let's turn over to Europe. And it's a sea of green, I believe, if it turns over. Car stocks were doing particularly well in the region. And finally, let's check to see where Wall Street might open later. And earnings very much in focus this week. The Dow just slipping down into the red there, but the S&P and the Nasdaq are both positive. Interesting to note that last month in October, the S&P 500 and the Dow climbed just over 2%. The Nasdaq, the tech-heavy Nasdaq, climbed almost 5% in October. So tech very much leading the way. Okay, that is it for Market Sunrise for this morning. Stay with Yahoo Finance for continuing live coverage of the markets and your money all day on streaming and online. Coming up next, join Julie Hyman ahead of the market open on Morning Brief. I'm Ramzan Karmali. Go own the morning.